Hi everyone, in this video we'll be going over accounts October-November 2020 paper 1-2. This is paper 1, which is multiple choice paper, and we are given 30 questions. We are also given a time limit of 1 hour, so we will be attempting to solve all 30 questions under 1 hour. Now without any further delay, let's get started. For the first question, we are given the inclusion of unpaid loan interest in financial statements is in accordance with which accounting concept? The very first option is consistency concept, and we know that this concept states that once you adopt an accounting principle or method, we need to continue to follow it consistently in future accounting periods as well. But in the given information, we are not talking about any sort of accounting principles or accounting methods, so option A is going to be incorrect. Then for the second option, we are given the going concern concept. And we know that this concept states that a business entity will continue running its operations in the foreseeable future and will not be liquidated or forced to discontinue operations for any reason. Again, in the given information, we are not talking about liquidation of a business or its foreseeable future. So obviously option B is also going to be incorrect. For the third one, we are given matching concept, and we know that this concept states that companies report expenses at the same time as the revenues are related to. It is also associated with accrual accounting, and in the given question, we are told that the inclusion of unpaid loan interest. So this loan interest obviously relates to this particular accounting period, and unpaid means that we are yet to pay this loan interest, which is basically the accrued loan interest, right? And these loan interests should be included in the financial statements according to the matching concept, as it states that the expenses should be reported at the same time it is related to, right? Which means that our correct answer is going to be option C. Let's have a look at option D as well. We are given money measurement concept, and this concept states that business should only record an accounting transaction if it can be expressed in terms of money. So this is definitely incorrect. Now we can move towards question number 2. So the question is, what is depreciation? The very first option states that it is a means of allocating the cost of non-current assets over its useful life. And this is correct because whenever we purchase any sort of non-current assets on which depreciation can be applied, we do not include all of its cost as an expense in the financial statements, right? We only record the depreciation, which represents the cost of the non-current assets over one accounting period. So definitely depreciation is a means of allocating the cost of a non-current asset over its useful life. Let's have a look at the remaining options as well. The second option states that depreciation is a measure of the decrease in the market value of the non-current assets. We definitely do not compare our cost with the market value of any non-current assets, so option B is incorrect. The third option states that depreciation is an outflow of cash from the use of non-current assets. Remember that depreciation is a non-cash expense, so there cannot be any outflow. Right? So option C is incorrect. Then the last one states that depreciation is the expense spent on the non-current asset. This is again incorrect because whatever expense that we spent on the non-current asset will be the cost, not the depreciation, right? So our final option will also be incorrect. Now we can move towards question number 3. A trader depreciates fixtures and fittings at the rate of 10% per annum on cost, which means that this is the straight line method, right? Then on 1st January 2019, a purchase of new fixtures and fittings 5,000 was posted to the advertising account in error. So this is actually the cost of new fixtures and fittings, but it was posted to advertising account in error. All right, now we need to figure out the effect of this error on the trader's capital account. All right, let's talk about our advertising account. Advertising account is definitely an overhead expense, right? But instead of posting all the cost amount of 5,000, we should be posting only 10% of the cost as a depreciation in our overhead section, right? So let's figure out the depreciation. That is just going to be the cost, which is 5,000, times the rate, which is given as 10%, which we can write down as 0.10. So the depreciation that should have been charged and recorded in the overhead section will have the value of 5,000 times 0.10, which is 500. But instead of this, we actually charged 5,000 to our overhead section under the heading of advertising account, right? Now we need to figure out the effect of this error on the capital account. And remember that capital account records the profits as well, right? And depreciation as well as the advertising cost falls under overhead, which will reduce the profit. So that's negative. So what we can say is that the capital account should be decreased by depreciation as well as the advertising expense. So actually, our capital account should have been only decreased by the depreciation amount of 500, right? So it should have been negative 500 only, but due to the error that we made by posting the entire cost value of 5,000 to the advertising account in error, we actually decreased our capital account by 5,000. Now our error is just going to be the difference between these two values, right? And negative will represent our understatement, whereas a positive sign will represent our overstatement. So let's figure out the difference or the effect. So our error is negative 5,000. So we need to subtract the actual amount that should have been reflected in our capital account, which is minus negative 500, right? So that's negative 5,000. Minus and a minus results in a plus, so that's plus 500. So our effect is of negative 4,500. So like I said before, this negative represents our understatement. So what we can say is that the effect of this error on the trader's capital account on 31st December 2019 will be understatement by the amount of 4,500. And this is given in option C. That will be the correct answer. Now we can move towards question number 4. A company had a non-current asset which cost 370,000. So this is the cost. Then the asset had a 10-year useful life and an estimated residual value of 20,000. So whenever we are given the useful life of any non-current asset as well as its residual value, we can easily figure out the depreciation, right? The formula is just going to be cost minus our residual value divided by its useful life. Alright, a full year's charge for depreciation is made in every year of use. After 4 years, the asset was sold and the loss on disposal was 30,000, whereas the disposal costs were 10,000. Alright, now we need to figure out our sale proceeds. So whenever there is a case of selling any non-current asset, we first need to figure out our accumulated depreciation for the years in which that non-current asset was used. And in this case, we are told that after 4 years, the asset was sold, which means that this non-current asset had been used for 4 years. So our accumulated depreciation is going to be the depreciation charge for 4 years. Let's figure it out. So we know that the depreciation charge per year is going to be cost minus its residual value divided by useful life. And in this question, we are given the cost to be 370,000 minus our residual value, which is 20,000. And we just need to divide it by our useful life, which is 10 years. So that's going to be 10. But remember that this only represents the depreciation for 1 year, whereas we are figuring out our depreciation for 4 years. So we can just multiply it by 4 in order to figure out our accumulated depreciation. So now the value for our accumulated depreciation is going to be 370,000 minus 20,000 divided by 10 times 4, which results in the value of 140,000. The next step would be to figure out the net book value. And net book value is just the difference between the cost and its accumulated depreciation. So our cost is 370,000. Now we just need to subtract our accumulated depreciation, which we just figured out to be 140,000. This gives the net book value to be 230,000. Alright, then we are already given the loss on disposal as well as the disposal cost. And the loss on disposal occurs when the net book value is greater than the sales proceeds. Right, which means that loss is just going to be the difference between the net book value and sale proceeds. So that's net book value minus our sale proceeds. And we are also given the disposal costs. And remember that disposal costs are always subtracted from our sale proceeds. So that's going to be minus sale proceeds minus disposal costs. All right, now we can just input all of the values in this equation and then figure out the value for our sale proceeds. We already have the loss on disposal to be 30,000. We figured out our net book value to be 230,000 right here. We need to figure out the sale proceeds value, and the disposal cost is given to be 10,000. Okay, now this is just going to be 30,000 equals to 230,000. Let's open this bracket, so that's negative SP plus 10,000. And this gives our sale proceeds to be 230,000 plus 10,000 minus 30,000, which results in the value of 210,000. Okay, this is the correct answer, and this value is given in option D. That will be our correct answer. Now we can move towards question number 5. Which item is recorded on the debit side of a sales ledger control account? So the very first one is interest charged on overdue accounts of customers. This is actually true because we record this in the debit side of a sales ledger control account. So option A is going to be the correct answer. Let's have a look at the remaining options as well. The second one is irrecoverable debts written off, which is recorded on the credit side. So that is obviously incorrect. Then we have returns of goods supplied to credit customers. So that's basically sales returns, which is again recorded on the credit side of a sales ledger control account. So this is incorrect as well. And the last one we have is total of cash sales. So remember that in sales ledger control account, we only record our credit sales and not the cash sales. So this item does not occur on either of the debit side as well as the credit side in a sales ledger control account, which means that option D is incorrect as well. Now we can move towards question number 6. A trader prepared a trial balance which did not balance. The difference was posted to a suspense account, and the following errors have now been found. We need to figure out the opening balance on the suspense account. Alright, I'm going to figure out the opening balance on the suspense account by correcting the errors given above. Okay, this is the debit side, and this is the credit side. Alright, so the very first one is the return inwards account had been overcast by 90. So remember that in our trial balance, return inwards represents the sales returns, right? So if sales is recorded on the credit side, then sales returns or return inwards should definitely be recorded on the debit side. But it had been overcast, right? It had a higher value than it required, so it should be subtracted. And whenever we need to subtract a value and correct it in the trial balance, we just need to post that value on the opposite side. So if the return inwards would have been recorded on the debit side correctly, in order to correct this overcast, we just need to record this amount of 90 on the opposite side, which would be the credit side. So that's 90 on the credit side. Then the second error is that a payment of 200 for rent had been entered correctly in the cash book, but had not been posted to the rent account. And remember that rent is an expense. Whenever we're talking about expenses, those will be recorded on the debit side in our trial balance, which means that we now need to record this 200 on the debit side representing the rent paid. So that's going to be 200. That is all of our errors. So now let's correct it. That's 200 total on both the debit as well as the credit side because that is the heavier value, right? Now our balancing figure will act as the opening balance value. And in order to figure out the balancing figure, we just need to subtract this value from the total. So in this case, that's going to be 200 minus 90, which results in 110. So the one thing to remember here is that I corrected these errors, right? But the opening balance would have occurred before the correction of these errors. So whatever the value that I got, this would be on the opposite side as the opening balance on the suspense account. So I got 110 on the credit side, right? Which means that the correct opening balance on the suspense account is 110, but on the opposite side, which is the debit side. This is our correct answer, which is given in option B. Now we can move towards question number 7. How would a credit entry of 500 in X's account have arisen in the books of accounts of Y? So let's prepare a journal. We don't know what is on the debit side. That is what we need to figure out. But we know that X's account is on the credit side of the journal. So that's X's account on the credit side with a value of 500. So we know that X is a personal account, right? And the personal account on a credit side represents that this person or X is a giver in this transaction. So we just need to figure out which of these options represents X as a giver. Let's have a look at the first one. It states that X bought goods from Y. So whenever X is buying something, he would receive something and not give something, right? So option A is definitely incorrect. Then for the second one, we have X returned goods to Y. Whenever X is returning goods, X will be giving out the goods to Y, which means that X will be a giver in this case, which is what we require, right? So option B will be the correct one. Let's have a look at the remaining options as well. Y made a payment to X. In this case, Y is giving money to X, which means that X will be a receiver in this case, which is not what we require. So option C is incorrect as well. Then for the last one, we have Y returned goods to X. Again, Y is giving and X is receiving. So that is again incorrect. Now we can move towards question number 8. An invoice for purchases were credited to the purchases account. How will the balance on the purchases account be corrected? So here the invoice was credited to the purchases account. Suppose the invoice was for value X and we credited it to the purchases account. This should not have been the case, right? Exactly opposite is what we require. So in order to get the X value on the debit side, if we include it once, then it gets cancelled out with the credit side value, right? So debit side represents nothing, but we require the amount of X on the debit side now, which is why we need to record X twice in order to rectify this error on the debit side, right? So we are looking for this in the options. The first one states that it should be decreased by the value of the invoice, but we are adding it, right? We are increasing it, so that is incorrect. The second one states that we should decrease by twice the value of the invoice. Again, we are increasing, so decrement would definitely be an error. Third one is increased by the value of the invoice. The value of the invoice would be just X, but we are increasing it by 2x, right? So this is definitely incorrect as well. And the last one is increased by twice the value of the invoice, which is 2x, right? So this is the correct one. Option D will be the correct answer to question number 8. Now we can move towards question number 9. Rent is paid by a business monthly in advance on the first day of each month. The payments during a financial year were as follows. So up to and including 1st June, the payment would be 500 per month, and from 1st July, the payment would be 600 per month. Now, which amounts will appear in the financial statements for the year ended 31st October? Okay, for a year ended 31st October, the months that we need to pay the rent for is going to be November, December, January, February, March, April, May, June, July, August, September, and October. And we know that up to and including 1st June, we pay 500. So that's for these months, we'll be paying 500. For the remaining 4 months, we'll be paying 600 per month. Okay, now we need to figure out the amount to be included in the income statement as rent, right? And for income statement, we just need to record the rent value for all of the 12 months. So that's 500 for the first 8 months, right? So that's 500 times 8, and then 600 for the remaining 4 months. And this will give the value to be recorded in the income statement to be 6,400. That is given in option C. Okay, and let's talk about the statement of financial position as well. We are providing the rent in advance on the first day of each month, right? So if we're talking about for the month of October, we will be paying the rent on the 1st October, and this represents the rent till 31st October. So obviously we will be recording in the financial statements for the year ended 31st October, which means that this prepayment would already be exhausted till our 31st of the October, right? Because the days have already passed, which means that this rent is no longer advanced, but this rent is already earned. So this just means that there would be nothing to be recorded in the statement of financial position as there is no advance rent paid, right? Which means that statement of financial position will record nothing, and this is given in option C. That will be our correct answer. Now we can move towards question number 10. What is the effect on profit for the year and net assets when accrued expenses are understated? Alright, accrued expenses are the expenses which should be included while calculating the profit for the year, right? But if expenses are understated, we know that profit is just income minus expenses. If expenses are understated, this will mean that the profit will be overstated, right? So for profit for the year, it's going to be overstated, which is given in option A and B. Now let's talk about net assets. Net assets is just the difference between our total assets and non-current liabilities and current liabilities, which means that basically net assets is just the capital, right? And if we're talking about capital, we know that the profit for the year will be added to it. So profit for the year is also a part of the capital, which means that if the profit for the year is going to be overstated, then the capital would also be overstated. And if the profit for the year is going to be understated, then the capital or net assets would also be understated. So in this case, our net assets is also going to be overstated because we already figured out that the profit for the year would be overstated as well. Now the correct answer for both the profit for the year and net assets is given in option A. That will be our required answer. Now we can move towards question number 11. Ali's trade receivables at 31st December 2019 were 26,500. He knew that 400 of these were irrecoverable, so this 400 represents bad debts. Then he wished to maintain a provision for doubtful debts equal to 5% of the trade receivables. At 1st January 2019, the balance of the provision for doubtful debts was 1,200, so this is the opening balance. Now, which entry does Ali make in the provision for doubtful debts account at 31st December 2019? So we need to figure out the closing balance of the provision for doubtful debts as well. Let's figure that out. So we have closing balance. We are given our trade receivables to be 26,500. And we need to subtract all of our bad debts before applying the rate for the provision for doubtful debts. So we need to subtract 400 because this is the amount of bad debts given in our question. Now we can just multiply it by our rate of provision for doubtful debts, which is 5%. So we can write it down as 0.05. That's 26,100 times 0.05. And this gives the closing balance for the provision for doubtful debts to be 26,100 times 0.05, which is 1,305. So we can see that our opening balance is lower as compared to the closing balance, right? So let's figure out the difference. That's just going to be closing balance of 1,305 minus our opening balance of 1,200, which gives our value to be 105. And remember that whenever the closing balance for provision for doubtful debts is greater than its opening balance, it represents the expenses, which means that this value should be recorded as an expense in our income statement, right? So if it is to be recorded as an expense, then we just need to figure out on what side would this particular entry be recorded in the provision for doubtful debts account. So we know that provision for doubtful debts would be recorded as an expense, which is the debit side, which means that this amount should be recorded on the credit side in the provision for doubtful debts account. So our correct answer is just going to be 105 on the credit side, which is given in option A. That will be our answer. Now we can move towards question number 12. Adil and Bashir were in partnership, sharing profits and losses in the ratio 2:1. Chandra joins the partnership and profits and losses are now to be shared between Adil, Bashir and Chandra in the ratio 3:2:1. Now the balances of the partners' capital accounts prior to Chandra joining the partnership are as follows. Goodwill is to be valued at 36,000 and is not to be retained in the books of accounts. We need to figure out the balance on Adil's capital account after Chandra joined the partnership. So I'm just going to create Adil's capital account here. This is the debit side. This is the credit side. So we have the opening balance prior to Chandra's joining for Adil to be 20,000. Then we need to adjust the goodwill, right? So previous goodwill before Chandra joining the partnership, that value should be recorded on the credit side. So let's figure that out. So out of 36,000, prior to Chandra joining, the profit and loss sharing ratio is 2:1. So 2 out of 3 parts is for Adil, right? So that's 36,000 times 2 by 3, which results in the value of 24,000. This should be recorded on the credit side as it is based on old profit sharing ratio. Now we need to figure out the goodwill value for Adil based on new profit sharing ratio, which is 3:2:1. So for Adil, that's going to be 3 parts out of 6 parts. So that's 36,000 times 3 by 6, which gives the value of 18,000. And this is the goodwill value based on new profit sharing ratio, which should be recorded on the debit side. That's going to be 18,000. Now the new balance is just going to be the balancing figure on the debit side. So first of all, let's figure out the total from credit side. That's the sum of these two values, 20,000 plus 24,000, which results in 44,000. This will be the total on the debit side as well. And now this balancing figure is going to represent Adil's capital account balance after Chandra joined the partnership. And in order to figure out its value, we just need to subtract this amount from the total. And in this case, that's going to be 44,000 minus 18,000, which results in the value of 26,000. So this is the answer that we require, and it is given in option B. That will be the correct answer. Now we can move towards question number 13. How is a loss on realization recorded when a partnership is dissolved? So we know that the loss on realization should be divided in the profit sharing ratio, right? And here for option A and B, we are told that it is to be divided equally. So automatically these two options are going to be incorrect. Now we just need to figure out on which side would it be recorded in the partner's capital accounts, debit or the credit side. Now, the thing to remember here is that loss is something that is going to reduce partners' capital accounts, right? And all of the reductions in the partners' capital accounts is always to be recorded on the debit side. So that's going to be option D. That is our answer. Now we can move towards question number 14. John and Brian are in partnership, sharing profits and losses equally. John receives a salary of $2,000 per annum. Brian loaned the business $5,000 and he is entitled to interest of 5% per annum. Alright, the profit for the year before appropriation was $24,000, and during the year, John took drawings of $3,000. We now need to figure out the amount of residual profit that Brian will receive for the year. Okay, so the very first step would be to figure out our residual profit from the profit for the year before appropriation. So that's $24,000. Okay, so the very first thing that is to be recorded in our appropriation account is the salary given to John, right? This definitely reduces the residual profit, so we just need to subtract the amount of $2,000. Then we are also told that Brian loaned the business, but this interest on loan should already be adjusted in the profit for the year before appropriation, which means that we no longer need to adjust it in the appropriation account. So we can just completely ignore this. Then we are also given drawings, but remember that the interest rate in the drawings is not given. So we just assume that there is no interest to be charged in the drawings. Now this concludes all of our appropriation account. So the residual profit is just going to be 24,000 minus 2,000, which is 22,000. But we only need to figure out the residual profit for Brian, right? Now we just need to divide it on the basis of the profit sharing ratio, which is the equal, right? Which means that there is only two partners, so we need to divide it equally among two partners. So that's 22,000 divided by 2, which results in the value of 11,000. And this amount is given in option C. That will be the correct answer. Now we can move towards question number 15. A company issued 100,000 ordinary shares of 1 each at a premium of 2, and the market value was $4 per share. Which statement is not correct? So the very first one is that the capital reserves increased by 200,000. We know that the premiums represent the capital reserves, and the premium is of 2 per share, right? So let's figure out the total capital reserve. That's going to be 2 times the number of shares, which is 100,000, which results in 200,000. So this means that our capital reserves has definitely increased by 200,000. So the statement given in option A is correct. Then the second one is that cash and cash equivalents increased by 300,000. So remember that cash and cash equivalents will increase by the total ordinary share value plus the premium share value. So let's figure out the cash. That is just going to be the number of shares, which is 100,000, times the value for the ordinary share, which is 1, plus the value for premium, which is 2. So that is just going to be 100,000 times 1 plus 2, which is 3, which gives our cash and cash equivalents to have the value of 300,000. This means that the statement given in option B is also correct. Now the third one is that ordinary share capital is increased by 100,000, which is true because our ordinary share has the rate of $1 and our number of shares is 100,000. So multiplying these two amounts, we get the value of 100,000. So the statement given in option C is correct. Now the last one is that the revenue reserves has been increased by 400,000. Remember that we are only talking about ordinary shares and premium in this question, so there is no revenue reserves involved right here, which means that revenue reserves will remain constant. It will not increase and not decrease. So the statement given in option D is definitely incorrect. And the question asks us which statement is not correct, so that would be option D. Now we can move towards question number 16. In this question, we need to figure out which item has no effect on the total equity of a limited company. So the very first one is bonus issue of shares, and this is the correct answer. And remember that in bonus issue of shares, there is no inflow of cash from any outside parties, meaning that we fund the bonus issued ordinary shares by our reserves, which is the capital reserve as well as the revenue reserve. So the total equity of a limited company will not be changed because the amount that is taken from the capital reserve or the revenue reserve is just going to be added to our ordinary shares. But in case of dividends paid, this actually decreases the retained earnings, which would have a decrement effect on the total equity of a limited company. So that's incorrect. The third one is rights issue of shares, which could increase our ordinary share as well as premium, which means that the total equity of a limited company would increase as well. So that's incorrect as well. And the last one is upward revaluation of non-current assets. This would definitely increase our revaluation reserve, which means that the total equity of a limited company would also be increased. So that's incorrect as well. Now we can move to question number 17. Information relating to W Limited for the year ended 31st December 2019 was as follows. Now we need to figure out the amount of retained earnings at 31st December 2019. Okay, let's start with our opening balance, which is the retained earnings value at 1st January 2019. That's 22,000. Then we have profits from operations. So remember that in our retained earnings, we do not add profit from operations. We actually add the profit for the year, right? And profit for the year is just profit from operations minus all of our interest charged, right? And we are given profit from operations to be 83,000. Let's subtract the interest, and interest basically represents the bank loan interest. So that is given right here, and it has a value of 16,000, which means that our profit for the year is going to have the value of 83,000 minus 16,000, which results in the value of 67,000. So now we need to add this value of profit for the year in our retained earnings, so that's plus 67,000. Then we have dividend paid, and remember that dividend is always paid from our retained earnings, which means that the amount by which the dividend is being paid reduces our retained earnings. So we need to subtract this value of 20,000. And then we have dividend proposed. Remember that dividend paid and dividend proposed are two different things, because dividend paid is already the cash out, whereas dividend proposed, there is no cash out yet. So we do not need to adjust this value in our retained earnings, so we can just completely ignore this. So our retained earnings at 31st December 2019 is just going to be the sum of these three values. That's 22,000 plus 67,000 minus 20,000, which results in 69,000. And this value is given in option D, so that will be our correct answer. Now we can move towards question number 18. Which financial information is not available for potential shareholders of a limited company? So the available financial information for any potential shareholders is going to be the income statement, statement of changes in equity, and the notes to financial statements, which is given in option B, D, and C respectively. And we have one remaining option in option A, which states cash budget. But remember that cash budget is not something that is available for potential shareholders, because it is just a budget that only the management and the employees use to forecast the future cash inflows of the company, right? So this is not to be disclosed to the potential shareholders, which means that option A is our correct answer. Now we can move towards question number 19. The following information is available. All right, we just need to figure out the rate of inventory turnover. So remember that rate of inventory turnover is just the cost of goods sold by average inventory. And we are given an extract from our income statement. So we have our cost of goods sold right here, because cost of goods sold is basically the sum of opening inventory purchases and minus closing inventory, right? So that's 240,000. Let's write it down. Now we just need to figure out our average inventory. So average inventory is just going to be the sum of opening inventory and closing inventory. And in order to figure out the average, we just divide it by 2. We have our opening inventory to be 46,000. Then we have our closing inventory to be 50,000. Now we just divide it by 2. So 46,000 plus 50,000 is going to be 96,000. Divided by 2, which gives our average inventory value to be 48,000. Let's substitute this in our formula. So the value of our rate of inventory turnover is just going to be 240,000 divided by 48,000, which results in the value of 5. And this is given in option B, so that will be our correct answer. Now we can move towards question number 20. A company's financial statements for the year ended 31st December showed the following. We are given the issued share capital, non-current liabilities, and reserves, including retained earnings. We are also given the company's profit from operations, which is 160,000, and profit for the year, which is 120,000. Now we just need to figure out company's return on capital employed. So the formula for return on capital employed is just going to be profit before income and tax divided by the capital employed times 100%. Okay, and profit before income and tax is just going to be profit from operations, which has a value of 160,000. So we can just substitute this. All right, now let's figure out the capital employed value. So the formula for capital employed is just going to be equity plus non-current liabilities. And the information we have is issued share capital, which is a part of equity, so it should be included in capital employed. Then we have non-current liabilities, which should definitely be included in capital employed. It has a value of 280,000. And we have reserves, including retained earnings. And reserves are also a part of equity, so we need to add this amount of 250,000 as well. And this gives our total capital employed to have the value of 150,000 plus 280,000 plus 250,000, which results in 680,000. Let's substitute this times 100%. So the return on capital employed is just going to be 160,000 divided by 680,000 times 100%, which results in the value of 23.5%. And this value is given in option A, so that will be our correct answer. Now we can move towards question number 21. Which cost can be classified as a fixed cost? So the first one is bank overdraft interest. So bank overdraft interest will vary according to the bank overdraft amount, right? So this cannot be classified as a fixed cost. This is incorrect. The second one is piece rate labor cost. So piece rate labor cost definitely depends on the pieces of the amounts of goods or inventory produced. So obviously it is based on the number of units produced, which cannot be classified as a fixed cost. It is a variable cost, right? So this is incorrect as well. Then we have sales commission. So sales commission is also going to be dependent on the number of units sold. Obviously this is also a variable cost, so it cannot be classified as a fixed cost. That's incorrect. Then we have telephone rental. So this is a rental. So rental charge is going to be based on an amount of time. So maybe the charge is going to be fixed for a month or any other accounting period, right? Which means we can classify telephone rental as a fixed cost. That will be the correct answer. Now we can move towards question number 22. An employee works a 40-hour week at an hourly rate of $8. She receives a bonus of 30% of the hourly rate for time saved producing each unit. Let's figure out our bonus rate. That is just going to be 30%, which we can write down as 0.30 of the normal rate, which is 8. So our bonus rate is just going to be 2.4. And this is for the time saved. So meaning that this bonus rate is also going to be dependent on the time. So that's going to be per hour. And the normal rate is also $8 per hour. All right. Then the target producing time is 30 minutes per unit, which means that for every 30 minutes worked, she needs to produce 1 unit. All right, then last week she worked 40 hours and produced 90 units. Let's figure out the number of units that should have been produced according to this target for 40 hours. So we can use unitary method. 30 minutes is equivalent to 1.5 hours, so that's 0.5 hour. We need to produce 1 unit. For 1 hour, that's going to be 1 by 0.5 unit. And we need to figure it out for 40 hours. So for 40 hours, that's going to be 1 by 0.5 times 40, which results in the value of 80. So according to the standard rate, she should have produced 80 units, but she actually produced greater than that, which is 90 units. And now we need to figure out her gross earnings for the week. Okay, we'll start with the normal rate. So for 40 hours, she will get $8 per hour, right? And then we need to figure out the bonus. Let's figure out the additional units that she produced. So additional units is just going to be 90 minus the standard unit, which we just figured out to be 80. So she produced 10 extra units, right? And these units should be converted into minutes or hours because our bonus rate is depending on the time, which is per hour, right? So again, we're going to use the unitary method. 1 unit requires 30 minutes, right? So 1 unit requires 0.5 hour. Then we need to figure out the time required for 10 units. For 10 units, that is going to be 0.5 times 10, which is 5 hours. So she actually saved 5 hours. So what we can see is that the employee actually saved 5 hours by making additional 10 units in her weekly 40 hours, right? So she deserves the bonus for these 5 hours. That's going to be 5 times the bonus rate, which is 2.4. Alright, now this gives her gross earnings for the week to be 40 times 8 plus 5 times 2.4, which results in the value of 332. And this value is given in option B. That will be the correct answer. Now we can move towards question number 23. A business uses weighted average, which is the AVCO method, to value its inventory. It purchased the following units of inventory. Alright, we're given the total cost for all 3 batches of units, and after these receipts, it issued 250 units to production. We need to figure out the value of the issue. So the value should be average value, right? Let's figure out the total of the total cost. So we need to add these 3 values. That's 3,600 plus 5,760 plus 4,320, which results in 13,680. So this is the total cost for all 3 batches. And we also need to figure out the total number of units. So we need to add these 3 values. That's 100 plus 120 plus 80, which results in the value of 300. So now we can figure out the average value per unit by dividing the total cost by the total units, which in this case is 13,680. That's the total cost. And we're going to divide it by the total number of units, which is 300. Alright, and this gives the average value per unit to be 45.60. Now we just need to figure out the total value for 250 units based on the average value of 45.60. So we just need to multiply these two numbers together. For 1 unit, the average value is 45.60. Now for 250 units, that is just going to be times 250, which results in the total value of the issue to be 11,400. This is given in option B, so that will be the correct answer. Now we can move towards question number 24. A business provides the following information. Alright, we are told that the variable overhead rate per machine hour was $4. So this is basically the variable cost. And we need to figure out the monthly fixed overhead cost. Okay, remember that our total fixed overhead cost is just the number of units times variable cost plus fixed cost. Right? Let's apply this formula to the information for April. So that's number of machine hours, right? That is 34,000. We need to multiply it with the variable rate, which is 4, and plus fixed cost will result in a total overhead of 493,000, which means that our fixed cost is just going to be 493,000 minus 34,000 times 4, and this gives the fixed cost value to be 357,000. And we can use the information for me as well, and if we get the same answer, that would mean that our answer is correct. Let's figure it out from me as well. That would be 67,000 times the variable overhead rate, which is 4 plus fixed cost, resulting in the total overhead of 625,000. This means that our fixed cost is going to be 625,000 minus 67,000 times 4, which again results in the value of 357,000, which means that this is the answer that we require. And this value is given in option D, so that will be the correct answer. Now we can move towards question number 25. A business absorbs its fixed overheads using direct labor hours. Alright, for the actual value is 600,000 and it is based on the labor hours of 14,300, whereas the budgeted value is 508,000 and it is based on the number of labor hours, which is 12,700. But remember that in order to compare, the basis should be the same, which means that the labor hours should be the same. So let's change the labor hours for the budgeted value. So for 12,700 hours, our budgeted value is 508,000. For 1 hour, that would be 508,000 divided by 12,700, and we require it for the basis of 14,300 hours. So for 14,300 hours, the required budgeted overheads is going to be 508,000 divided by 12,700 times 14,300. Alright, and this gives our required budgeted overhead to have the value of 572,000. Comparing it with the actual overhead, we can see that the budgeted overhead is lower than the actual overhead, which results in the under absorption. And we need to figure out the amount as well. So the amount is just going to be the difference between the actual value and the budgeted value. So that's going to be 600,000 minus our budgeted value, which is 572,000. And this gives our under absorption to have the amount of 28,000. Alright, so the correct answer is the under absorption of 28,000, which is given in option B. That is going to be the correct answer. Now we can move towards question number 26. A company sells a single product for 24 per unit. The variable cost is 8 per unit. Let's figure out the contribution. That is just going to be the difference between selling price and our variable cost, which gives the contribution per unit to be 16. Then fixed costs have been absorbed based on a normal activity level of 1000 units at 6 per unit, which means that our fixed cost is just going to be 1000 times 6, which results in 6000. And remember that this fixed cost is not to be changed with the change in level of outputs. Alright, now we need to figure out the profit under marginal costing if the company makes and sells 1250 units. Okay, so the profit is just going to be the number of units, which is 12,050, times the contribution per unit, which we just figured out to be 16, minus the fixed cost, which is 6,000. And this gives the required profit to have the value of 14,000. And this amount is given in option C, so that would be our correct answer. Now we can move towards question number 27. A product has the following revenue and costs per unit. We now need to figure out the contribution to sales ratio. Alright, contribution to sales is just the contribution per unit divided by sales price per unit times 100%. Now let's figure out the contribution per unit. We are given the marginal cost of 22. Alright. Then we are given the fixed manufacturing overhead of $6 and non-manufacturing overhead of 2. And remember that contribution should not be including the fixed cost, right? So we should be subtracting this fixed manufacturing overhead of 6. But remember that non-manufacturing overhead should also be a part of contribution. So we need to add this $2, which gives our contribution per unit to be 22 minus 6 plus 2, which is 18. Let's substitute this. And we need to divide it by the selling price, which is 40. Times 100%. This gives our contribution to sales ratio to have the value of 45%, which is given in option C. That will be the correct answer. Now we can move towards question number 28. Which statements about cost volume profit analysis are correct? So the first one is it applies over any time period. This is actually incorrect because cost volume profit analysis only applies over a short time period. Then the second one is it is suitable for any range of output. Again, this is incorrect because cost volume profit analysis is only suitable if there is only one product. And the third one states that profits are calculated using marginal costing, which is absolutely true. So the only correct statement is going to be 3, and that is given in option D. That will be the correct answer. Now we can move towards question number 29. Two costs at two levels of production are as follows. So we're given 10,000 units and 16,000 units and their corresponding costs. Fixed costs will increase by 30,000 if more than 20,000 units are produced. And we need to figure out the total cost if 25,000 units are produced, which means that we require the variable cost as well as the fixed cost. And we can figure it out by creating two equations by this information. So that's number of units times variable cost plus fixed cost gives the total overheads of 230,000. Now let's create the second equation. That's going to be the number of units of 16,000 times variable cost plus fixed cost is going to have the total overheads of 320,000. Let's subtract the second equation from the first one. That's going to be 10,000 variable cost minus 16,000 variable cost, which is minus 6,000 variable cost. The fixed costs cancel each other out. Then we have 230,000 minus 320,000, which results in minus 90,000. So this gives our variable cost to be minus 90,000 divided by minus 6,000, which results in 15. Now we can easily figure out the fixed cost by substituting this amount of variable cost in any of these equations. So that's going to be 10,000 times the variable cost of 15 plus fixed cost equals to 230,000, which means that our fixed cost is going to be 230,000 minus 10,000 times 15, which results in the fixed cost to have the value of 80,000. Alright, now we need to figure out the total cost if 25,000 units are produced. So that's going to be number of units times the variable cost of 15 plus the fixed cost of 80,000. And remember that the fixed cost is to be increased by 30,000 if more than 20,000 units are produced. And we are definitely producing more than 20,000 units. So we need to add another 30,000 as well. Alright, this gives the total overheads to be 25,000 times 15 plus 80,000 plus 30,000, which results in 485,000. And this value is given in option B, so that is the correct answer. Now we can move towards question number 30. Which are benefits of a budgetary control system? So the very first one is that it can be used to control expenditure, which is absolutely true because we forecast the expenses, right? Then the second one is it can be used to record accounting transactions. This is incorrect because this is only a budget, so it cannot be used to record accounting transactions. Then the third one is it can help when applying for a loan. This is true as well because we need to provide future financial statements as well when applying for a loan, and budgetary control system definitely helps to produce future budgets, right? Then the fourth one is that it can identify where improvements are required. This is absolutely true because we compare our forecasted values with the actual values and see where improvements are to be made, right? So this is correct, which means that the correct statements are 1, 3, and 4, and this is given in option C. This will be the correct answer. Alright, this concludes our paper 1-2 for October-November 2020. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.